Good day, everybody. We are back with another portfolio management series video. This one is on the risk tolerance questionnaire, which in my opinion is broken. And normally when a client or prospective client would go through a risk tolerance questionnaire at a big Wall Street firm or a non-fiduciary broker or a traditional advisor, you fill out these questionnaires with questions like, if the market dropped 20%, what would you do? Choice A, buy more. Choice B, do nothing. Choice C, sell. And there's a few things wrong with this. One, and perhaps the most important, is it's impossible to recreate the fear and panic that come with the market sell-off. And these questions out of context can lead someone to believe that a pullback is an obvious opportunity. I can tell you in the moment, a 20% pullback feels anything like an opportunity. Only in hindsight do we look back and say, oh, I should have bought more. So what ends up happening is people think they're risk-seeking investors. They embrace risk during good times or during a non-panic time. And then when the inevitable market correction comes, they are surprised about their true range of outcomes on their true drawdown of their portfolio. And the other thing these risk tolerance questionnaires do is they cause us to anchor to weird things. And what I mean by that is I've heard many people identify as a 60-40 investor or a balanced investor. And I think that's a mental shortcut that can lead to some dangerous conclusions, because again, what we saw in March of 2020 during the COVID sell-off, a 60-40 portfolio might have been down by 20%. And the investor that anchored to that identity didn't understand that that was a possible outcome. And they might have aborted their well thought out long-term investment plan just because they didn't really understand risk in the context of how they were invested. And really the third thing is, and this kind of piggybacks off number one, during a time where the market has basically gone straight up for 12 years, people get complacent, people get lulled into a sense that they are risk-seeking investors. If you're a conservative investor in a time like this, bond yields are paltry, fixed income returns this year are mostly negative, inflation is running hot, that might incentivize you or nudge you to take more risk than you set out to. It's a fear of missing out. If all your friends are making money around you, that's often the worst feeling, since humans are social beings and we want to be like those around us. So all of these different factors taken in isolation might be impactful, but taken together can lead to some dangerous conclusions and some misallocations of assets. So what we're going to be talking about today is how a professional investor or a professional advisor frames risk, how we think about risk, and how that manifests itself into an allocation. So I'm going to share my screen. So we are going to get started here with our friend Bush Shermans, who again is my Lasso Opso dog. And we're going to buzz through some of the soft data. We'll say Bush has $1 million to invest. Nice round number. Bush is born 10/27. Let's say he's born in 1965. He was born in 2012 for those that care. He just turned 9. So 63 in dog years, 65 in human years, close enough. Okay. So our first question is, how much risk can you handle in 6 months? This automatically sets off alarm bells for people because we've been conditioned to be long-term investors, and that's mostly correct. However, what we found is it's really hard for people to stick to a long-term investment plan if they don't understand the range of short-term outcomes. So we bring your range of outcomes forward to help you understand how much risk you're taking in both dollar terms and percent. So $1 million portfolio, 14% loss would be 140,000. I think the dollar term in dollar terms is important because 14% doesn't have the same pain factor as if I said you have the potential to lose $140,000 in 6 months, right? That might freak you out a little bit. So we like to show both because sometimes percent isn't as meaningful to people as the real dollar amount. So as you can see, I can move this slider to more conservative. The drawdown gets shallower. More aggressively, the drawdown gets steeper. somewhere in the middle. We'll say Bush is comfortable with the 10% loss. Nice round number there. I really don't stress too much about the upside. No one really cares about making 10%, but they do care about losing 10%. It's been shown in studies that humans hate losses much more than they enjoy gains. So we're focused on the downside. Moving right along, what if I could improve that? So this was our first choice. The choice here on the left, less risk and same upside. So you can notice the drawdown's a little shallower, the upside's the same. And conversely on the right, we have more upside for the same amount of risk. So Bush is feeling optimistic. What would you choose now? So this was our last choice. This was our first choice, which is no longer available as a choice. So Bush says, can I take even more risk down here for more upside? He says, I don't think so. So we'll stick with the answer. And the last question, what about now? Up 16% or down 10 or down 11 and up 17. Okay, let's try to squeeze a little more out of this portfolio. Bush needs some kibble. So Bush's risk number is 56, okay? This is designed to look like a speed limit. And as you might guess, the higher the number, the more risky the portfolio would be. So if we're driving 100 miles an hour and we're drinking and driving, that would be rather reckless. In an investment portfolio, that would be like small cap Israeli tech stocks. So very risky the higher we get. Conversely, on the low end, a risk score of 0 would be 100% cash, and you're sitting in a parking lot parked with the keys out of the ignition. All right, you can see Bush is somewhere in the middle, and these are Bush's range of outcomes based on his risk score. And there's a couple things here. One, again, this is based on $1 million. This is the range of outcomes over the next 6 months. This includes 95% of all historical market outcomes over the last 100 years or so. So this includes mostly everything except for the weirdest moments. The weirdest moments would be out here, and they would be called outliers. So what's an outlier? Think 2008. Think March and April of 2020. So weird market environments. But 95% of outcomes, 95% of the time, Bush's range of outcomes would be between -11 and +17 over any 6-month period. So yes, that feels like Bush. Okay, Bush, that sounds like you. I'm going to move this over here. That sounds like Bush. Let's go ahead and confirm this. Yep. So this is Bush. This is Bush's range of outcomes based on $1 million portfolio. Risk score 56. You can see this in clear terms here. So this is good. We're not anchoring to anything weird. We're not identifying as a 60-40 investor. We fully understand the range of outcomes. So this is the way Bush views the world. Really, the next step to this and what we do for folks is to build a portfolio that reflects the way Bush feels about risk. And contrary to what many people think, the time to do something, the time to ironclad your portfolio, the time to dial in your investment portfolio for the next market event is right now. It's not after the market drops 30%, you go in and make a bunch of changes. That's reactive. That's not efficient. That leads to emotional and poor decisions. So what we do is map a client's risk score to an investment portfolio. And I'm going to skip a step. The second step is comparing Bush's risk score to actually how he's invested. So matching a portfolio with the way Bush feels about risk. So we're going to go into our models. You can see we create our own models here at Pure Portfolio. So I can map the risk score that's closest to Bush's, in this case 55, to how Bush feels about risk. And you can see the range of outcomes here. I'll just change this to $1 million. You can see the range of outcomes are very close to what Bush's are. That's a good thing. And again, what we're missing is comparing how Bush is actually invested to his current risk score. And most times we do this, people are either underinvested or overinvested. And I can tell you over the last couple of years, most people are taking more risk than they set out to. Again, back to my earlier comments, up markets tend to embolden people to take more risk because they don't want to miss out. And then the cycle turns and they end up aborting mission because they were out over their skis. So this is just a more modern way to quantify risk. We all know what risk is. Sometimes it's hard to understand in the context of a investment portfolio, but you want to avoid the stale questions of if the market dropped 20%, then what would you do? That's meaningless. You want to understand your range of outcomes both in dollar and percent. And I can tell you investing is very much like the old pilot's quip. It's hours and hours of sheer boredom punctuated by moments of terror. So you want to make sure that your portfolio matches the way that you feel about risks to keep your portfolio invested and to avoid any emotional or poor decisions when the stuff hits the fan. Thanks for checking in. Feel free to leave a comment. Would be happy to look at your portfolio. Pure offers free portfolio reviews. And know that 90% of our clients come from other advisors. So don't make the assumption that just because you're working with an advisor that they're thinking about risk in the correct term. Okay? Have a wonderful day and talk to you soon.